Coming up today, Powell says inflation progress has stalled, with more Fed members saying higher for longer, sending bond yields up again. IMF upgrades global growth, Citigroup upgrades gold, and more troubles for Tesla. So we got a little bit of a follow through from yesterday's down move. Lower highs, lower lows today. Now actually got utilities underneath the long-term 200-day moving average. Even energy shares gotten a little weaker underneath the 20-day, but we've still got uptrends in volatility, bond yields, gold, the dollar, and inflation expectations. We are starting to look a little technically oversold in the short term here. You can see that in my S&P 500 oscillator. Approaching oversold levels. Same deal on my DSI. Getting oversold levels here. And short-term breadth. Really oversold. Only 9% of stocks above their 20-day average. This is normally when we have a bit of a bounce in the markets. And we did get a bit of a pullback in volatility today, still elevated above 18. However, the most important news story today was hearing from Jay Powell's latest speech, with him joining the rest of us and confirming that inflation progress has stalled and giving indication that he can hold rates higher for longer until he sees some material progress on that. One way you can translate that is he doesn't want to jump the gun and he's worried about further upticks in CPI. He's probably already got a heads up on some data around the corner, doesn't like what he sees, so he's setting the stage to stay on hold for a while. And it's really up for debate whether the current monetary policy is actually restrictive or loose. Some say it's actually not tight enough, as evidenced by things like retail sales, unemployment really low, risk assets at all-time highs, and we've got other members of the Fed jumping on board this narrative as well, with the Fed Vice Chair saying recent economic strength and hot inflation readings may justify holding interest rates steady for longer. And so it shouldn't really come as any surprise. After the record amount of Fed liquidity, government stimulus, low rates, that went on for years and years and years, we're never just going to see a one-year uptick in inflation, then it's all over and done with. Inflation doesn't work like that. It comes in waves and can hang around for a decade or longer. And who knows how long it'll hang around this time, since we're really in a new world when it comes to Fed liquidity and government intervention into markets. Like I've been saying for a while, 3% may be the new 2%. And the bond market's already been pricing this in for a little while now and just gave it further ammo to send yields up again today across the curve. We can see that on the 2-year. Forming a bull flag, and higher highs, higher lows again on the 10-year, now almost reaching 4.7 today. Sending the popular bond ETF TLT lower again, same deal with high yield bonds and what's clearly a risk-off environment across markets now, which is also supportive of the dollar, as people have clearly been going to cash these last few days. This is on the back of the International Monetary Fund updating their global growth forecast, saying the global economy has proved surprisingly resilient. Now expecting global growth of 3.2% this year, up by 0.1% from its earlier forecast in January. And that's a pretty good number, above 3%. Still below global inflation, so we can't outgrow our inflation at the moment. And of course, a big influence on this is China and how their rebound goes. But regardless of that, it hasn't only just been the Fed that's keen to cut rates. We also heard from the European Central Bank President Christine Lagarde saying they will cut rates soon, barring any major surprises, and she's extremely attentive to the price of oil. Similar to Jay, she said she needs to build a bit more confidence in this disinflationary process. But if it moves according to our expectations, we don't have a major shock development. We're heading towards a moment where we have to moderate the restrictive monetary policy. And they're in a bit of a different setup over there in the Eurozone. Got far lower growth than the States with a similar amount of inflation. So they have better reason to come out like the Swiss central bank and try and get ahead of other global central banks in cutting, help weaken their currencies, which then in turn helps their exports become better priced for offshore buyers. And there's a look at the Euro 10-year government bond yield, 2.48%. United Kingdom's just popped up as well to 4.3%. And there's the yields loosening up over in Japan as well, steadily climbing towards 1%. And so even though we're having a bit of a pullback in the stock market at the moment, a lot of people are calling for buying this dip, including research from Bank of America that suggests a 19% gain in the S&P by August next year. They highlighted the stock market's 12 consecutive months of positive year-over-year gains, and that signal suggests that equities still have a bullish backdrop despite weakness this month, saying to don't lose sight of the secular bull market that we're in. On the other side of the coin, we've got some bears saying the stock market could still face a 10% correction, even as the Fed nails a perfect, no-landing economic recovery. That's well-known researcher Ed Yardeni, who observed strong retail sales in March and an updated first quarter GDP growth estimate of 2.8%, saying the US economy is still flying high. That's because consumers didn't get the recession memo. However, he still thinks the S&P is at risk of testing its 200-day moving average, currently around 4,700 over the next few months. That's the level I said yesterday. That coincides with the 50% pullback from this move off late October. And if we were to do that, that's about a 10% correction. So most years in the stock market, we will get a 10% correction at some point. This could be the perfect opportunity for that, as we can often get a bit of seasonal weakness mid-year before normally going into a stronger part later in the year. And just looking at bond yields and the higher VIX, that's definitely some material headwinds for the stock market here. Even if we don't get this 10% correction, we may just consolidate for a month or two. And traders are hedging here. We can see that not only in the spike of the VIX and the VVIX as well, which is the price of VIX options, but also in the volume of trading in VIX options. We normally do around 800,000 contracts a day. I think on Friday we did a little over 2 million. A lot of people hedging. But hedges cost money. That's why the best place to be this year has been in gold. With Citigroup saying it could soar 25% in the next 18 months, getting up to $3,000 per ounce. And believe it or not, gold ETF flows are still negative. Looking at last week's data, total holdings by global ETFs dropped 8.3 tons. For the month of March, they were down 13.6 tons. And Q1 this year, holdings dropped by 113 tons. So even though we've got a ripping gold price, there's still not a lot of public and institutional participation in this rally yet. And there's a look at the price of gold here, just kind of consolidating. We are a little bit overbought here. Same deal with silver. Just pulling back a bit off this resistance zone, may consolidate for a little while here after we've had a really good rip. Crude as well, kind of in a holding pattern. And we are just 2 days away from the 4th ever Bitcoin halving, when basically the amount of new Bitcoins mined every day gets cut in half as a way to limit its supply. And this happens every 4 years. There'll only ever be 21 million Bitcoin in existence, and the last of the halvings is set to be mined around the year 2140. And just looking back at past history, the halving's impact on the price of Bitcoin has been muted, at least initially, but they've preceded the start of Bitcoin boom cycles by a few months. You can see that in this chart here, with the vertical lines showing the halving date, and then typically the market then goes on to rally afterwards. However, maybe it is different this time, since we've got the introduction of spot Bitcoin ETFs in the market, already accumulated over 60 billion in assets, and usually when everyone's aware of a pattern, now that it's happened 3 times in the market, often it won't occur again, because after something happens 2 or 3 times, the market kind of catches on. However, that doesn't mean we can't go into another multi-month rally, and it is currently sitting just around a bit of a support zone here, around 62,000 a coin, and Ethereum a little bit weaker as well, below its 50-day. Moving on to another big news story today, more trouble for Tesla. Like I've been saying, the Cybertruck and Robotaxi present really good medium long-term opportunities for the company and shareholders. However, in the short term, may present more risks, and we've just seen that today with news that Tesla's delaying some Cybertruck deliveries and a sign they may be having some production issues. However, we're not too really sure, as they're not given a reason for the delayed deliveries, and they're not returning comments to media inquiries. However, if they can pull it off, it should be a really hot product, definitely unique, different from what's out there, grabs attention, and if they can sell them at a good profit margin, this should help keep their lofty valuation going forward. However, they've still got a lot of hurdles on production quality and delivery times, and hopefully don't run into any regulatory issues as well. However, today's shares did fall through a important level of support I've had drawn in here for a while, $160 a share. We're now down into the 150s. Current market cap around $500 billion, and like I said, the next big target zone for Tesla is low 100s, which could set up for a potential double bottom there. We're also getting into the thick of Q1 earnings season. Just heard from United Health Group. They reported better than expected. Shares up 5.2%. Johnson & Johnson didn't fare better though. Even though they beat, shares came off 2%. And we just heard from Bank of America and like JP Morgan, they got slammed down as well, 3.5%. And a little bit different from Morgan Stanley. However, that was a bit of a dead cat bounce after they sold off with JP Morgan. Just recovered a little bit of ground on their earnings today. Not too much out in the way of economic data. We got some inflation prints out of Canada. Year over year, a bit hotter than expected, 2.9% headline. Core at 2%. Housing starts in the States a little bit lower than expected, as are building permits. Fed Fund futures still pricing in a cut come September. Fear and greed index dropped again today, down to 38. Still nothing noteworthy to report from corporate insider trading. A little bit of a fall here. Price of cocoa today down 7%. A lot of trend followers in this trade now. All the CTAs and managed futures are heavily long this market. Still got a bit of a pullback in Chinese securities after a little bit of a head fake above that trend line. And Barber back down underneath $70 a share. I'll be looking for it to hold that previous level of support around 67.50. And Clean Energy, just clean took out that level of support. Looking at a long-term monthly chart, looks like we're still in the process of a stage 4 decline, yet to proven that it's made a bottom and start a stage 1 accumulation. Those yield sensitive sectors Not liking what's happening in the bond market. Utilities and REITs are sliding here, along with dividend-paying stocks. As you look at cannabis, just consolidating. Apple's quickly reversed course, now back down to support, and NVDA just still kind of hanging around its 50-day. Another big jump up in Super Micro today, and a further pullback. And a stock I'm currently interested in, A-Mark Precious Metals, looking for a pullback to the 50-day here. Currently around 33.70. And on the back of Bank of America's report, we've got Citigroup and JP Morgan finding new lows again here today, and what had otherwise been a pretty hot sector for a few months there. All right, guys, there we have it for today. I have nothing further to add other than to say thanks very much for tuning in and hitting that like button. Cheers.